Welcome to the weekly review of the markets for week ending February 22nd, 2019 from Hernandez Retirement Services. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against losses. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, I will go over the Dow Jones Industrial Average. Will the rally ever end, and is it in a bullish pattern yet? After that, I will review the importance of being patient by going over the Dow between the years 1936 and 1938. Getting back to current times, I will go over three leading sectors in the U.S. Infotech, Aerospace Defense, and Healthcare. Brazil is still in a bullish pattern. With the Fed signaling more easy money policies last week, if inflation creeps up, what asset may benefit? How is the 10-year U.S. Treasury holding its own during the onslaught of a rally by the U.S. stock markets? Is it still in a bullish pattern? Finally, we end with what does it mean? This week, I will switch gears and look at the Dow Jones Industrial Average. Last week, the index rose 0.57%. Now this chart looks almost exactly the same as the S&P, which shows it is highly correlated to the S&P. But more important, let's read what the Dow is telling us. 1. It peaked at the beginning of October. After that, it started a drawdown, where it chopped around under its 200-day moving average several times. Eventually dropped in December, and the 50-day moving average followed suit. But the U.S. markets after Christmas began a counter-trend rally, and that is where we are now. Now, we have yet to pass the old highs, and the 50-day is still below the 200-day. For a bullish pattern, one needs the 50 on top. And to have any long-term rally, we obviously have to break through the old high. Right now, though, it has been a nice rally, but it is still in recovery mode. But we will need to be patient and not front-run a possible, and I will emphasize, possible bullish pattern. Market events of the past are never the same as what we go through currently, but we can still learn from them. Some things don't change. A long-term bullish run needs the 50-day above its 200-day. So let's look at Dow Jones Industrial Average during the years of 1936 through 1938. Now, what we don't see in this chart is that the Dow had been rising since the lows of 1932. Now, after years of an upward rally, the Dow hit a peak in late February of 1937. It started a downward trend, which eventually took price below its 200-day moving average. It could not recover, and the 50-day fell below the 200-day. Eventually, Dow found a floor and began a 2-month rally, where it gained close to 15%. Now, pay close attention to the chart. 1. It never passed the old high. It failed and began a pullback. The pullback was strong enough to halt the rise of the 50-day moving average. The Dow eventually dropped about 37% from the failed peak. The most important aspect for using moving averages as a baseline indicator is to understand the true direction of the market. Is it in a bullish or bearish pattern? The 50-day above the 200-day is one way to identify a bullish pattern. Now that I probably scared the bejesus out of you, let's move back to our current markets and the leading sectors. Back to the current charts. Let's look at New York Stock Exchange Infotech Index. Last week, I demonstrated how this index was one of the stronger ones in the US. As we retrace its trajectory, it peaked in late September, found a floor, bottomed out in late December, and has rallied since. It pulled back a bit and started a new rally. The chart shows some positive signs. The price of the asset is above its 200-day moving average. And now the 50-day is kissing the long-term line. Now, will it continue? Will we get a pullback to test whether this is a sustainable long-term bull sector? We are getting close to an answer. This is a great sector to keep an eye on. Now let's see what other sector is showing positive signs. Making another appearance in the videos is the Aerospace and Defense Sector Index. This sector has followed more closely the major indices path to the bottom. Like the Dow has yet to have a pullback to test its possible long-term strength. A positive sign is that the 50-day is sloping in an upward pattern and has the 200-day in its sights. But what can we see from the red line on top is that the sector is still recovering. It is still below its peak of 2018. And the 50-day, while looking good, is still below its slower moving average. Now let's check out another leading sector. A new sector that popped on my scans is the New York Stock Exchange Healthcare Index. Now here we see a very different pattern. For one, this index for a long time held its own when the markets began their fall. In fact, during the initial downtrend of the major markets, this index did not fall below its 200-day until mid-December. Its peak was reached later than the two other sectors we just saw, as it reached that point in late November. Now, it has ridden the upward trend of the US stock markets. It has been choppier, but it has shown strength by overcoming several small pullbacks. Now, what is promising about this index? One, price is above its 200-day. Two, though we had a death cross just recently, it happened as price was rebounding, and thus we see the 50-day halting its downward trajectory. The next two positive steps will be for it to pass the old highs and getting the 50-day back above its 200-day. Now let's take a look at one of the few global stock indexes that is in a bullish pattern. There was another positive week in the Brazilian Bovespa. This index gained another 0.37% last week. Now I want us to focus on the path to a bullish pattern. After all, we are witnessing in the US what the Bovespa was able to accomplish and stay in. Now we see in October, price did get above its 200-day moving average, and it began a slow grind higher while the 50-day crossed above it in November. Once there, we see price get tired, stall, pull back before the next rally. Along this path, price has gotten up, The 50-day line is still sloping up, and the 200-day line is beginning to slope higher. Right now, it looks like another slow grind higher for this index, with its next target to break is the high reached in early February. This index has barely been in a bullish pattern for 3 months, so it is still in a young phase. Like a plane getting off the ground, the initial attempt to rally in a bullish pattern can have turbulence, but it still finds a way to grind higher. Let's see if this can grow up and be a big winner. 2019 has been the year of the Fed. First, there was the confirmation that was rumored late in 2018 that the Fed was putting a halt to the rate hikes. That helped jumpstart the rally of 2019. Then last week, the Fed doubled down on easy money policy as they just stated they would stop for the foreseeable future, reducing their balance sheet. So, they do not mind seeing inflation creep up. Now, if they don't mind seeing rising inflation, would gold benefit? Well, gold is not new to my videos, as I have kept an eye on it for months. In fact, it has kept its rally going, albeit with a couple of short-term pullbacks. Now, price is showing strength. It has kept above its 50-day moving average despite some dips. Now, notice how the 200-day is starting to flatten out. Now, whether the Fed is helping this asset along or not is not important to chart reading. Gold has been in a positive trend and has the possibility to continue and get into a longer-term bullish run. Now, let's look at one tough cookie of an index that has held strong despite the stock market rally. Here we see the 10-year US Treasury note. In the previous video, I did say there was some short-term downward pressure on the index, and the US stock market's rally last week, which should have put more pressure on the index. And you know what? It still gained 0.12% last week. Now, despite the US stock market rally, this index has so far survived and stayed in a bullish pattern. Price has now gotten into a very tight trading range, so at some point there will be a breakout one way or the other. How has this uncorrelated asset survived the rally of the US stocks? Is it that all assets are going to be in a bullish pattern? Do bond traders know something that stock traders don't, and thus keeping this government obligation in strength? For now, we just take it for what it is, short-term weakness. The 50-day is beginning to bend to a more flattish pattern. Is this just price resting before its next run up, or is it the slow fizzling out of a short-term bull run? Like equity markets, we shall see in several weeks. What does this mean? What are we to make of this US stock market rally? There has been a V-shaped rally off the lows of December 2018, but it has yet to get the 50-day above its longer-term 200-day moving average. Recency bias will tell us we are in a strong bullish run, but we have to remember the fall from October was deep, and as of last Friday, none of the major indices have completely recovered from it. There are many positive signals, but the job is not completed. Unlike former President George Bush, I will not state mission accomplished before it actually is. I would like to see a small pullback at some point soon to test whether this is a bull trap or the beginning of a major melt up. Can you imagine you were investing in 1937, seeing a 15% rally from May to mid-July, thinking the next bull rally was coming, pulling the trigger to jump in before the 50-day moving average crossed above the 200-day just to see it fail and drop another 37%. I did not show these charts to scare anyone, but to give proper context of what is a true bullish rally. Rallies can come from depressed or strong assets. It is understanding whether you are in a bull or bear pattern. As I have said before, using moving averages do not predict market trends, but it gives you a baseline of what direction the market is in. Are we in a healthy bull rally or a recovering bear rally? My opinion is that there is no need to front run a possible bull run. Markets will dictate that. When the 50-day finally gets above its 200-day, then it will be time to use the old Russian proverb, trust but verify. I would like to thank you for viewing this video, and I hope it was helpful. Please like and subscribe to my channel for future videos.